Okay, so you're a founder. You've poured everything into your idea. And now it's time to raise your first round of capital. It's got to be one of the most exciting, but also one of the most nerve-wracking moments, right? You need that fuel to grow, but the big question is, how do you get that funding without giving away the very company you've worked so hard to build? It's a huge decision, so let's break down the two main ways you can go.
And that, right there, really hits the nail on the head. The kind of agreement you sign for that first check, whether it's the SAFE or traditional equity round, has massive implications. We're not just talking about money here. We're talking about ownership, your power to make decisions, and pretty much the entire future of your company.
So let's get into it. We're going to break down both of these options. And don't worry, we're skipping all the dense legal jargon. We're going to focus on what this stuff actually means for you, the founder, so you can make a smart choice that really protects your vision.
First up, let's talk about the SAFE. You've probably heard about these. They become super popular for early-stage startups. And the best way to think about a SAFE isn't as some complicated investment. It's much simpler. Think of it as a promise.
A SAFE is not a loan, which is huge. No interest, no repayment date looming over your head. And critically, it's not you giving away a piece of your company right away. It's really just a clever way to get cash in the door while, kicking the can down the road on one of the toughest questions for a new company. So what are we actually worth right now?
So why are founders so into SAFEs? Honestly, it all comes down to speed and simplicity. A lot of the time, you can close a deal with a single, standard document. That means you get to avoid weeks, maybe even months of legal back and forth. This lets you keep total control and stay focused on what actually matters, building your product and locking down your IP.
But of course, an investor who comes in super early needs some kind of protection for taking that risk on you, right? That's where something called a valuation cap comes in. Just think of it like a ceiling on the company's valuation for that investor. It's how you make sure that the people who believed in you from day one get rewarded if your company's value suddenly skyrockets.
Let's make this real with an example. Imagine an investor gives you cash on a SAFE with a $5 million valuation cap. Okay, now fast forward a year. You've hit all your goals, you're crushing it, and you go to raise a priced round at a $10 million valuation. Well, that first investor, their money doesn't convert at that new higher price. Nope, it converts at the $5 million cap, which means they get way more equity for their money. It's their big reward for betting on you before anyone else did.
All right, so that's the SAFE. Now let's flip the coin and look at the other side, the classic equity round. This isn't some promise about the future. This is a formal partnership that you are entering into. Right here, right now.
See, unlike a SAFE, an equity round forces that whole valuation conversation to happen immediately. You and your investors have to agree on exactly what the company is worth, and then you sell them a concrete percentage of the business, actual shares, for their cash. The whole transaction is done and dusted.
This means you're playing a whole different ballgame with a totally different set of trade-offs. Yeah, it's slower, it's way more complex, and it's definitely going to cost you more in legal fees. But what you get in return isn't just a check. You get a true shareholder, a partner who is now formally on your team, maybe with a board seat and voting rights. And honestly, that level of accountability can be incredibly valuable.
So you've got these two very different paths. How do you weigh them? Well, it really just boils down to a fundamental choice between keeping your short-term control versus making a much deeper, long-term commitment. Let's put them head to head. A SAFE that's really your best friend in those super early, kind of messy stages, when you're still pre-product and just need cash to get things built. It's fast, it's simple, and you keep all the control. An equity round, on the other hand, starts to make a lot more sense once you've actually got some traction and you have a much clearer idea of what your company is worth. It's more complicated, for sure, but it brings in real partners who have a real stake and a say in where the company goes next.
Okay, enough theory. Let's turn all this into a practical framework. How do you actually decide which of these is the right move for your startup right now? Think of this like a little checklist. If you're nodding your head as I go through these, then a SAFE is almost certainly the way to go. So, are you pre-product or pre-revenue? Do you need cash like yesterday to build or file patents? Do you really want to put off setting a firm valuation? And is keeping 100% control your absolute #1 priority right now? If that's you, a SAFE is your best bet.
But what if your situation looks a little different? Maybe it's time for a full equity round if you've already got proven traction. Maybe you have users or even revenue. Your key IP is locked down and protected, and you're not just looking for cash anymore. You're looking for strategic partners to help you scale. You feel ready for that structure and the accountability that comes with having shareholders.
Ultimately, this is the question every single founder should be asking themselves. This choice between a safe and equity, it isn't just about money. It's a massive strategic decision. It's about balancing what you need right now with your vision for the long haul. It's all about protecting your ownership and your control so you can actually build the company you dreamed of. So, which path gives you the fuel you need but on terms that protect your future? That's the decision that truly matters.